You can even get a true disability policy. I'm not talking
Mm-hmm.
about disability waiver of premium. I'm talking about an actual disability policy that gets stacked onto a whole life insurance policy, where again, because they know how to underwrite that permanent death benefit, they can safely stack on other policies like that. And while we're on that topic, how about critical illness protection? Some whole life insurance policies, you can advance yourself a portion of that death benefit, not only if you have a long term care need, but if you have a critical illness like heart attack, stroke, cancer. How about
Right.
that? If we're going to do an apples to apples comparison
Yeah.
with, say, an investment, which is not the right one, but that's the one they always do. Okay, if you're going to compare it to that investment, now you got to subtract the cost of term. You got to subtract the cost of a long term care insurance policy. You got to subtract the cost of a critical illness policy. You got to subtract taxes and fees. You got to make an adjustment for risk and volatility. You got to subtract out an umbrella policy because of the creditor protection and whole life insurance. Where does it end? Where does it end?
Yeah.
This is why there was a study done that calculated if you want to get the same benefits in an investment type strategy that you're getting in whole life insurance, the rate of return you would need to get in that investment to match the benefit you're getting in whole life insurance is 17%. 17%.
Hold on.
That's
You
the
mean
rate of
Dave
return you would
12
need.
is not enough? Hold on. What? Dave's 12 is not enough? Come on, man. Come
12% ain't
on.
enough. Ain't enough, man. Not enough.
It's funny I bring that up because there was an episode where Dave actually talked about self-insuring long-term care with mutual funds. And I think that a lot of people don't really know the ramifications of using money. I was like, oh, okay. So they pull all this money out. And then if they're in a long-term care facility, are they still getting really good tax advice for capital gains? Like,
Yeah,
'cause-
they're going to pay taxes on it. Right. Look, this should be obvious, but if you want life insurance, buy life insurance. Don't put money
yeah,
into an investment account and say, well, that'll be my life insurance. If you want
yeah,
long term care insurance, buy long term care insurance.
yeah,
Don't put your money into investments and say, well, that's my long term care insurance. It's just an
right.
excuse to siphon all of your money into the Wall Street casino and tell you that'll cover for anything. If you
Mhm.
take the idea of self insuring anything to its logical conclusion, you should never have any form of insurance. Stop wasting your money on homeowners
Right.
insurance, DeAndre. The likelihood of you using that policy is very low. So take the money you're throwing away on homeowners insurance and put it into the market instead where you earn 12%. And then if something does happen to your house, you'll have a big stack of money that you can use to pay for that.
Yeah, that's perfect. That sounds perfect. Except for when I get that mold remediation bill.
Yeah, but you're coming back to taxes again. If you have $100,000 in cash value available to you in your life insurance policy, you actually have 100,000 and you can
Right.
use it without interrupting the gains or any of the benefits of the policy. If I have
Mhm.
$100,000 in the market and I want to use it, I have to withdraw it, which means now I lose all the benefits because I withdrew the full 100,000 and I pay taxes on it. And how much taxes I'm going to pay could be pretty high. It just depends where I'm at.
Absolutely. Absolutely. Yeah.
The problem
Absolutely.
again is they're looking at whole life insurance as if it were a stock market investment. And they're making a lot of assumptions. And they're looking at it in a vacuum. Once you
Mhm.
contextualize it, all these other benefits become so important. So we've
Yeah.
talked about whole life insurance as a volatility buffer. So if you do have those market-based assets and you're going to be using those for income in retirement, you do not want to be drawing from them when the market has crashed, which it does once every 10 years or so. So probably 2 or 3 times during retirement, the market's going to crash like 30%. You're not going to want to touch your money. You're going to want to let the market recover. So what do? Well, you take out policy loans, you draw from your whole life insurance policy while you let the market recover. And now your portfolio can last 10, 20, 30 years longer than it otherwise would have. That
Mm.
benefit is not something that you can see from looking at the whole life insurance policy in isolation.
Yeah, I think David Kinder, he had an article on this in particular about how he transitioned from wanting, like, he was an investment guy initially, and then he just stuck with life insurance only. And he said, what made me stick with life insurance is when I ran the math, I found out how much more efficient the money was even at a lower account balance. So I can have less money, but that less money does so much more and protects my back in so many different places that if I were to try to equate the same in investments, it's something I can't average. So I think that's really what people need to understand. It's not necessarily that, oh, this one returns higher than this one. No, that's actually irrelevant because there's other factors that come into place. There's health factors that come into place. If I were to argue about how much a health savings account returns or how much a 529 returns, that's all good and dandy, but the money is locked to those situations. They're locked to health or it's locked to school. And on top of that, I think people also forget that when you're talking about at least 529s in particular, most people don't know about qualifying for college. So they say, oh, don't talk about using life insurance as a replacement for that or assisting with it. But life insurance does not go into the calculation of scholarships.
Right.
Yeah. How much you have.
It's a non-includable asset. So when you're applying for financial aid,
Absolutely.
you don't have to include it. The other thing is the sequence of returns risk. They keep saying you cannot time the market. Well, especially if I'm putting money into a 529 plan, I'm forced to time the market because when my
Correct.
child turns 18 and they go to college, I need the money then. I cannot wait
Mhm.
if the market has crashed. I cannot wait. So
Yeah.
now I have a huge timing issue.
That's a
The other
very astute. Yeah.
And of
Very.
course, they say you cannot time the market, but you're forced to time the market because I have to take my distributions at some discrete point in time.
I,
I have
yeah.
to. I must time the market. There is no question about it because I must buy the market asset at some discrete point in time and I must sell it at some discrete point in time. So there is
Yeah.
no avoiding timing the market. So if you're saying you cannot time the market, then don't be in the market to begin with. You have to time
So,
it. To a certain
yeah.
extent, you must. The other thing I found too, tell me what you think about this, DeAndre. With most things, absence makes the heart grow fonder. So the grass is always greener on the other side. You always wish you had what you don't have. I wish you could get access to what you don't have today. But whole life insurance seems to work the opposite way in that people appreciate it more when they have it. When people don't have whole life insurance, they really don't know what they're missing and they don't feel the loss because it's an
Mhm.
invisible loss, if you will. They don't feel it. But when people have whole life insurance, they appreciate it more and more and more, and they want more of it. The older they get, the more they want
Yeah.
more of it. They're like, hey, I want more. Hey, yeah,
Yeah.
$20,000 a year. No, I want more. Give me more because they understand what it's doing for them.
Oh my.
Have you
That's a
found that
very
to be the case?
that is so profound because so I'll tell a personal experience. I have a client who is a bank executive and her husband and I are really close. And I'm close to her as well. But they had watched some content and they decided, hey, I want to talk to you about these insurance policy things. What was really interesting was typically because she's so high powered, the time to understand the concept was not there. She's, oh, okay, whatever he says. So what ended up happening, they needed a little bit of cash somewhere else. This time, he said, we bought the policy with DeAndre. We should have cash value there. So they go to the policy and they say, DeAndre, how do we access it? And I said, that was all a part of our initial meeting, but okay. I said, okay. So I ran them through what to do. I said, so you guys did not set up the bank account. You didn't. Okay. All right, cool. So we'll just work on that right now. So we set it up. About 2 days later, she said, okay, I requested this loan. It's a scam. And I said, why did you say it's a scam? She said, because when I requested the loan, it said loan processed. That's all it said, loan processed. And I never met with anybody. Now, remember, she wasn't taking time to understand how different this is as an experience. And so I said, why don't you call them, right? And ask them about the loan. So she says, I'm going to do that. So she called up and she was really robust in her way of talking to them. And she said, oh man, I took this loan out and it just said loan process. I don't understand it. Nobody called me. Nobody did this. It just seems like a scam. It's a total scam. And so the lady said, the loan was processed. We have it showing that we mailed it out and it should be there in the next 2 days. And so she's like, are you for real? She's like, yeah, it'll be there in the next 2 days. She was like, but why didn't I have to meet with a loan officer? And so now bear in mind, she's a bank executive. So this is probably why her mind is this way. And so the lady said, the reason why you don't have to meet with the loan officer is because you don't have repayment terms. She said, I don't have repayment terms. She said, yeah, you don't have repayment terms. She said, would you like to set repayment terms now? She says, what kind of clown show is this? No way. Not happening. This is ridiculous. It doesn't even make sense. What are you talking about? And so the lady says, the reason why you don't have repayment terms is because whatever is outstanding can be taken from the death benefit. And so she was like, I seem to remember hearing something about.
Yeah,
So
it's a good illustration of how people take whole life insurance and they try and fit it into their pre-existing paradigm where it
yeah,
doesn't fit. And that's why to them it looks terrible. No, it's so good it doesn't fit in your paradigm because your paradigm is designed by the Wall Street sharks who are taking
right,
advantage of you. You've got to change the whole paradigm. It
right,
always
right.
happens where when you talk to people, some people, and they ask questions, okay? This will sound a bit self-righteous, so I apologize. If you want to call me self-righteous for this, that's fine.
I'm
When
calling it.
when our Lord was asked a question, did he
Mhm.
answer it directly?
He said,
Almost never. Almost never. He would either ask a question back or he would tell a story. The reason why is because there's always a preconceived notion, a preconceived paradigm behind the question that has to
mhm,
be addressed. So when people pepper you with questions like, you won't answer my question, you scam artist, it's like, no, your question says, I have a pre existing paradigm. Don't you dare challenge it. And I'm going to fit you into it. So what's my return on investment? Answer my question. What's my return on investment? Hold on. Hold on. This is not an investment vehicle. Why do you think return on investment is a relevant metric? There's so many preconceived notions behind that that need to be addressed. You're being evasive. No, you're trying to bully me. You're trying to fit me into your pre-existing paradigm, which is
right,
created for you by Wall Street, and your Stockholm syndrome won't let you challenge it. So we got to take a
right.
step back, think big picture, be open to new information. And it's not information, it's a new way of thinking.
It's a new way of thinking.
Because we can all look at the same whole life policy illustration, but depending on what your pre-existing paradigm is, you might reach wildly differing conclusions, right?
Wildly different conclusions. Now, her final conclusion after all of this and feeling foolish, she calls me and she says, man, why did I only put that much money into? I need 10 of those. So it's after really recognizing it now that she's utilizing it, it now becomes something that they fall in love with. And I think that's something that needs to be highlighted because the investment community, what they do oftentimes is they demonize it because they don't understand it. And because most of them don't
Right.
own one either.
And the other problem is they view it as competition when it's
They
not.
view it as competition.
Whole life
Yep.
insurance is not competing with your investments. If
Yep.
people buy whole life insurance, they will have more capacity to invest their money in the long run. And again, it's the unseen, the investments they have will be protected. So the investment advisor just sees the cash flow that's going to the whole life insurance and cash flow that he isn't getting anymore because he wants all your money, not just some of it, all of it locked up forever. What he's not seeing is 10 years in the future, when that person has a health issue, they will not withdraw 50,000 from their investment account. They're not going to have to raid that because they'll have their whole life insurance policy. So it's the future loss that you're avoiding. It's the market volatility that your client can now ride out because they have
Mhm.
this other rock solid asset. You will actually do better as an investment advisor if your clients have whole life insurance. These two are not competing with each other.
You could argue that it even allows you to continue contribution
Yep. Take out
because
policy loans and use that to finance your investments.
because of those things. It could allow contribution in a transition of a job. Hey, I'm moving over to this role and I'm taking 2 months off. it could allow contribution while taking that 2 months off and putting money into a brokerage account. So I think that they're short sighted in their viewpoint because greed will make you short sighted. Let me go ahead. I
Yeah,
don't want
yeah,
it seems like they're short sighted because they want to do what's best for you. No, it is a greed related aspect. And I'm not normally the person who wants to call it out that way because I try to be nice. But in reality, if you believe that they can't coexist, if your idea is that you have to buy term and you have to invest the difference, what you're saying to the person is, for your insurance needs, I want that to be hypothetical for you, but I want the investment side or what I get paid off of to be definite. So it's okay for your family and whatever happens with your family to be up to hypothetical. It's okay for that to be up for chance, but your investing is absolutely important because that's how I end up getting paid. If they looked at all of your money and they say, I understand that you want to invest some money, but this is also going to serve as a way to preserve your ability to invest in different things. So I could argue as a disability event happen. Well, when a disability event happens, you're not investing anyways. But what if you had a policy that was paying you? Could that not allow you to continue investing? It's a very short term view because it is based on greed instead of based on the longevity of the relationship with the client. And they argue that life insurance agents don't care about the relationship with the client when the life insurance agent is the one there when the client dies, which is wild to me that people that's the worst time in a person's life for their family. So the life insurance agent is going to be the person delivering a check.
yeah. Peter Nelson says, we are the only ones who deliver money to you. We
That's
come
it.
carrying cash. Other people come to take money away from you, right? Your
Yeah.
investment advisor, he might be doing a good job, but he's like, hey, you need to give me money. You need to give me money so I can invest. We do the opposite. We come at the worst possible time, your time of biggest need, and we deliver a check.
Yep.
We bring cash, tax free, no strings attached, no market risk. Here it is when you need it the most. D'Andre, have you ever had a widow complain to you that her husband was overinsured?
No,
Have you
never.
ever had a widow complain to you that it was a whole life insurance death benefit instead of a term life insurance death benefit?
No. No, that's foolish. No, I've never heard that before. Never
So,
heard that.
yeah, we protect widows and orphans. This is what we do. We protect
Yeah.
widows and orphans.
Yeah. Life insurance in general is purposeful money. The other money, and this is the differentiator, a financial advisor or planner is using money that is a plan. Plans fail. Life insurance is financial purposing. So once you understand that, a purpose is typically never going to fail because it's intentional that despite the hurdles that may happen in life in general, I've put something in place for this purpose, for that win. Plans fail when the wins happen. Purpose kicks in when the wins happen. Purpose takes care of the ifs and the wins, whereas plans are like, whoa, I got to readjust. Plan A, plan B, plan C, plan D. You don't have that analogy for purpose A, purpose B. Nobody's ever heard that analogy because purpose doesn't necessarily fail. So I think that once you understand that the beauty of what life insurance can do for a person is adding purpose to a dollar adds better sleep.
Let me contradict myself a little bit. It is true that whole life insurance is not competing with these investments. And by investments, now I'm just talking about the Wall Street casino, because when people say investments, they're only narrowly focused on that. There
Right.
is, however, a competing philosophy oftentimes between the two. What I notice is that the more people put into their whole life insurance policy, the more they start to differentiate what a real investment actually looks like. They stop contributing to their 401k. They stop putting money in the stock market. They stop buying mutual funds. Not that I ever tell them to do that, but they just
Yeah.
look at that and say, There's a lot of risk and volatility, and I have no control over it, and there's no guarantee. I'm okay just letting my money work for me in a whole life insurance policy. I don't miss the hypothetical 8, 10, 12% returns I might get. It's just not worth all the other baggage that comes with it. Then they start to know what a real investment looks like. Like I have a client just took out a policy loan to make a down payment on a vacation rental property. That is
Mm.
cash flowing. It's paying them. It's something that's paying them. Marin Katusa, who's a wildly successful speculative investor in the natural resource space, likes
Mhm.
to use the comparison of an alligator. If you want to be an apex predator like an alligator, what does the
Mhm.
alligator do? He does the opposite of dollar cost averaging. Dollar cost averaging means I'm just putting money into the market every month. That's not what good investors do. What does the alligator do? The vast majority of the time, nothing. Absolutely nothing. He just sits there pretending like he's a log just floating around doing nothing. Absolutely nothing. It's only when a nice juicy prey comes really close by that all of a sudden he springs into action, he
Yeah.
grabs the prey and he pounces. And
Right.
this is what Marin Katusa does as a speculator. Most of the time, he's sitting on the
Interesting.
sidelines with
Yeah.
cash. And if you have
Mm.
cash in a whole life insurance policy, it's earning you a safe return. So your wealth is still growing. You're still earning compound interest. But when a real investment comes along, and by the way, that's subjective
Mm.
to you, Marin
Right.
Katusa is buying natural resource stocks. I would not recommend that for the average person. And if we're talking real estate is specific. A real investment is specific to you. What are you good at? What do you know?
Mm.
And investments are not required. You don't have to invest your money. Just keep saving it. That's fine. People who have money in whole life insurance policies and they're safely building capital where it's inside their control and not at risk, they are much more disciplined about doing what Warren Buffett does, which is saying no 99% of the time.
Yes.
Saying no 99% of the time. They know what a real investment looks like. And it doesn't look like what the Wall Street sharks are offering them.
No, that's a good point. I'll have to use that. I like that, the alligator analogy. That's pretty cool.
Yeah, Marin Katusa. When I ran my investment newsletter, I talked about that one. That was definitely in my presentation. We do with Marin Katusa because I'm telling people there's not going to be like a new investment idea every month because good investments don't come along every month. That's not the way this works. We're going to have a small portfolio,
Right.
few positions, not a lot, and it's going to be rare that we're going to add a new one. So more is not better. It's actually the opposite. Marin Katusa's portfolio
Mm.
was like 8 stocks, and that was it. And they were all in what he knows best, which is natural resources. He would never have more than maybe 12 positions, and he would rarely add a new one.
Hyper diversification doesn't really benefit you if you know what you're doing.
It's like betting on every horse in the race.
One of the funny things is that financial advising or regular planning, it is an assumption that you don't know what you're doing because they all tell you that you need to be hyper diversified. Oh, you need a lot of diversity. But I got a client who really don't care nothing. I mean, nothing about the market. He's not invested in the market at all. Filthy rich. How did I meet him? I was doing Medicare and I came to his house and the man owns a llama farm.
Cool. Cool.
And the whole deal with it being a llama farm is he said the reason why I got involved, no, alpaca farm. It's an alpaca farm. The reason why I got involved with alpaca farming is because alpacas grow back their fur. He said they grow it back really quickly. And if you've ever seen how much alpaca rugs cost, hand over fist. So he's looking at his ROI there and he's saying, I'm manufacturing it by feeding alpacas. I don't care nothing about throwing money over here with the potential of this when
Where
I
you have
know,
no control, where you have no
yeah,
control. If you start a business, there's risk, but A, you're not putting a lot of capital at risk. It's more your blood, sweat, and tears, not a lot of money. But
right,
you have some degree of control over your business. If you
mhm,
buy real estate, same thing. You have some degree of control over it.
some degree of
You have
control.
no
Yep.
control over what's going on in the market. That's speculating. And it's okay to speculate, but just understand the difference. If they were required, like we're required to call it what it is, speculating, then people, rather than saving for retirement, which is not what it is, okay, Imagine if
Hey,
the
you did
Wall
it
Street,
right. It's gonna
yeah,
do my thing.
imagine if the banks and Wall Street had the reams of compliance that we have to go through. When you go to deposit your money in the bank, you know what they would do? They would sit you down. They would say, DeAndre, we want you to understand this is not actually a deposit. What you're actually doing is you are loaning us your money and you become an unsecured creditor of the bank because it's our money, not your money. So you're not making a $10,000 deposit. You're loaning us $10,000. You know what we're going to do? We're going to take that and we're going to pyramid $100,000 on top of your 10,000 and we're going to loan it out to other people. So not only have you made us a loan, so it's not your money, but the money isn't even there because we've loaned it out. So when you give us $10,000, you're giving us a license to print more dollars on top of it, which will
Right.
punish you via inflation. And we're going to
Yeah.
make you sign this in triplicate because our compliance department wants to make sure you actually understand we're not allowed to call it deposit. We get fired and lose our licenses if we call it a deposit. If
Oh
we
my
don't have all
God.
this paperwork signed in triplicate with the blood of your firstborn, then we can't take your money. And we cannot take your money.
I ain't gonna lie. Everybody who's teaching infinite banking will be filthy rich if that was me.
Yeah, and so they yell at us when we talk about banks, and it's, well, an insurance company is not a bank, right? I have
Yeah.
people make sarcastic comments like that, and it's like, yes, I know, of course. Nelson Nash knows an insurance company is not literally a bank.
Right.
But when you look at the way cash value in a whole life insurance policy works, conceptually, if you understand what banking actually is, which most people do not,
Right.
it operates much more like a real bank than what we call a bank today. Because what we call a bank today, JP Morgan Chase, Wells Fargo, are actually legalized counterfeiting enterprises. They're not banks. It's
Right.
hard for people to understand this, but there was a time that banks were very well respected, very well trusted institutions. Back when we had sound money, gold, and the banks were actually banks. They added a
Mm,
tremendous amount of stability to the financial system because you didn't
mm,
have to keep your gold with you and risk being robbed. You could deposit it, an actual deposit, not a loan, in the bank, and the banks kept it safe and insured. And it wasn't free. There was no free banking. You paid them a fee because they're providing a service for you. And that made
mm,
the economy much more stable and much more safe and much more secure. And the banks were sound. They had the capital and your money remained yours. They're just custodying it for you. That's what banks are supposed to do. So in a whole life insurance policy, there is more than a 100% reserve requirement. Every dollar in cash value that's there is backed by more than a dollar in reserve. So it
mhm.
operates more like a real bank. When you deposit, quote unquote, your money into Wells Fargo, you have not made a deposit. You have made an unsecured loan to the bank. You become an unsecured creditor of the bank. That's how it works.
Yeah. Yeah. That's
So
exactly how.
so they always catch us on little technicalities that miss the point. Meanwhile, they're allowed to outright lie and call it a deposit when it's not, or call it
What?
saving for retirement when it's not a
Oh,
savings vehicle.
characterizations. So blunt. The lies.
I know, I know. If they had to deal with the same sort of compliance that we did, that's what would
Yes.
happen. That's what would happen.
Absolutely.
An attorney
Absolutely.
would sit you down and make sure you understood this and make sure you signed the paperwork, and he would have a knife right in the back of the agent. And as soon as anything was filled out incorrectly, twist the knife, fire the agent, get rid of him. He's not compliant.
Yeah. No, it's interesting you brought that out because what I've seen, especially in the financial industry, is the misuse of words. Whenever I say something and say it's mischaracterized, everybody says mischaracterizations are semantics when it comes to investments. They say, oh, it's just semantics when it's an investment. But when it comes to infinite banking, it's not infinite and it's not banking. And it's,
Right.
oh, I thought we understood semantics. Oh, what happened? As far as infinite is concerned, one, Nelson doesn't qualify what infinite completely is. Part of it is that it's non interrupted. If you look at an infinity sign, and I think people don't even think about that as far as an infinity sign not having a break in it, that's what Nelson is talking about from the interest accrual standpoint. You don't have to stop and take a step back or stop and then grow the next year. You grow the entire time. So that's the infinite time frame. So does it last forever? No, because then a death benefit pays out. We understand that. We get that. But then the other part is, do you know if what he was talking about from an infinite standpoint is the amount of things you can do with it, which is what we've been talking about today. Is
But let
that,
me correct you a little bit, DeAndre. The
you
time
know,
frame is, in theory, infinite because you're talking about intergenerational legacy planning.
right,
Follow that through. A death benefit pays out. What happens? That death benefit goes to a trust where the death benefit proceeds are required to be used to purchase the next generation of life insurance
right.
policies. Now, you could
So
argue there's some interruption in the compound interest curve at that point. You got to start the curve over again, but the capital base doesn't decrease. It keeps increasing
it
because
keeps
now it
increasing.
goes into the next generation of policies,
Yeah.
just like
Mm.
what the Rockefellers do.
No, that's a good point. That's good.
And are we not allowed to engage in marketing? When you use marketing terms, of course, you're not going to be 100% technically precise. If the
Right.
compliance departments had their way, everything would read like the instruction manual to a microwave oven. There would be no marketing and no one would ever buy anything or understand anything.
You're correct. Because buy term and invest the difference doesn't actually happen because they apply it only to life insurance, but nobody goes through this life in America without other insurances.
Mm.
They're not investing. Nobody can buy term only and invest the difference. Nobody can. It's impossible.
Do they actually even start with that? Do they actually sit their client down and say, Mr. Clayton, here's what a whole life insurance policy would cost you. And here's what the term policy is going to cost you. And now we're going to take that difference. Well, they don't even know what the difference is because they don't know what a whole life insurance policy would cost. And of course, you and I both know asking what a whole life insurance policy costs misses the point. I get that question a
Yeah,
lot. So if I wanted a million death benefit, how much would that cost? Depends. What would a
yeah.
2,500 square foot house cost? Depends. Depends on how
Depends
you
on
design it.
how you design it. Depends on the floor. Depends on the roof.
Well, and it just shows how Wall Street has programmed them to think this way. It's like, wait a minute, what's the goal? Forget about the cost. Forget about returns. What is the goal? What is the
Oh,
purpose? What are we trying to accomplish here? And then let's find the most efficient way of accomplishing it. And of course, these compliance departments, what I'm just pointing out is let's not be naive. We all know it's not like our wonderful friends at the SEC and FINRA and government are just so worried about the average consumer that they put together these rules to rein in their friends at Wall Street. No, obviously, the Wall Street people and the congressmen they control got together and said, okay, let's put together these rules and make it seem like we're protecting the consumer. But really, what we're doing is creating this maze of compliance to make it as difficult as possible for money to escape our grasp. But we can pretend we'll sell it to the public like, hey, we're just trying to make sure that your best interests are protected. Because, of course, your best interest means putting money into the Wall Street casino. We can't have you put your money in whole life insurance policies. That's not in your best interest. That's guaranteed. There's no risk, DeAndre. You need to take on risk. Come on. We don't make any money from that.
you trying to make money? You gotta take on risk, man. Come on, man. What are you doing? You gotta be willing to lose it all. What's wrong with you?
Yeah. So that went way far afield. There's so much more we could talk about. But DeAndre, anything you want to say in closing?
Add purpose to your dollars is basically the point of this entire discussion. Is that everything else is very hypothetical, and plans do not replace purpose. They're a part of purpose. When you're looking at how to properly evaluate whole life insurance and all the things that it does, think about all the things that can happen and all the things you want to protect yourself from. And whatever that last place is that you want to be, whatever your goals are, it'll become a lot more clearer because you at least have things that have closed the gap in understanding of what can happen. So,
Excellent. And on that note, DeAndre, thanks so much for your time. We greatly appreciate it. As always, we'll look forward to the next one.
always a pleasure, my friend.